Hello, welcome back to the continuing lecture in investments. And our topic, what's wrong with my, okay, so our topic is equity valuation. And we have been, for the last couple of sessions, we've been discussing, the four versions of dividend discount models for equity valuation. So we've already discussed, two models, constant dividend or zero growth model, and then constant dividend growth model or golden growth model. Now, before we move on to the variable growth models, let's first briefly think about why the market price is most of the times, especially in the short run, different from the intrinsic value. What makes that, of course, market price is different from the book value, that goes without saying, because of the time lag and the discrepancy between the actual solid book data, which is in the past, and the growing expectations. I mean, the market price is basically reflecting the expectations of the market, right? And the expectations of the market is rational in the long run, but in the short run, it's irrational, because in the short run, you are in a you don't have perfect information. You don't have perfect insight. So most of the times, of course, the expectation is based on the past performance, and the past performance is basically represented by the earnings, right? Earnings per share. But again, since the last earnings report, right, which is done quarterly, right? If time has already lapsed sufficiently since the last earnings report, then the market is forming its own expectations about the current earnings, right? Because as of the last earnings report, if almost 2 months have passed, 2 months and almost 3 months have passed, it's almost time for the upcoming earnings report. But let's say we are at somewhere around 2 months past the last 2 months and a half past the since the last earnings report. I mean, the market is in then complete vacuum of actual solid. So a lot of noise will build into a lot of noise will build into market's expectation about this company's earnings performance, right? So you can easily say the main reason for the market deviation of the market price from the book value or from the intrinsic value is because of the irrational expectations. But again, mathematically, it is called present value of growth opportunities, which can be related to the dividend payout ratio. Now, what is dividend payout ratio? Oh, we all understand. It's not difficult, right? From the earnings, right? Um, we're talking about the earnings we're talking about is, of course, EAT, right? Earnings after taxes, right? A small fraction of that is paid out as dividend. If the dividend payout ratio is 10%, suppose company's earnings is $10 million, which is, of course, net profit, right? This may be confusing. Right? And if 10% is the, suppose, no, this is 10%. What does that mean? 1 million paid out as dividend. That is 10%, right? And then the difference is called what? The difference is called retained earnings. Retained earnings. Retained earnings. And in this case, that would be a 9 million, right? And also this 9 million is also called plowback. Plowback. The plowback ratio is then 90%, right? In this example, plowback ratio is and because retained earnings are supposed to be put into reinvested into the company's expansion, right? Company's growth. Um, of course, in principle, but if the company's, growth rate is meager, then they rather put it into. I mean, if it is even, less than the average market return, then uh, they would rather put it into the stock market, right? And average market return. But let's assume that they are growing at a uh, better than average market return, then they will uh, put it plow back, right? They will plow back this 9 million. So plowback ratio is simply, right? This makes sense, right? 1 minus dividend payout ratio, right? Plowback. So they are like complementary. If payout ratio is 20%, then plowback ratio is 80%. And then the growth comes from the combined effect of this, return on equity and plowback ratio. I mean, combined is not the right word because combination is like additive, but this is a product because it's an intersection. You understand? It's an intersection of growth rate is basically the intersection between return on equity and plowback ratio. You can think of it this way. How much of the you can consider that as return on equities, synergy with, right, plowback, right? You can consider that as synergy between the two. This is so hard to write. Synergy between the two. Okay. So how much of return on equity is helped by plowback, or vice versa? So then, think about it. If there is no plowback, if this is zero, right? If there's no plowback, right? Or yeah. If everything is paid out as dividend, then plowback ratio is zero. And of course, growth rate will be zero, right? So, so then we can simply calculate no growth value of the company by dividing, earnings per share by return, right? In other words, required return. Why? Because where did this come from? Think about it. All of what is the Gordon growth model? It's the dividend, right? Dividend at time one over. Come on. I'm sorry. That's I'm hitting my mouth. The mouse, hitting my mouse because the mouse is sticking and it's acting up. It's not moving as I want. But think about it. If there is no plowback, all of the dividend is basically 100% of the earnings per share is paid out as dividend, right? And then G is zero, growth rate is zero, so it becomes this, right? So basically, think about it. Price of the stock is, in other words, V0 is like this. And what is the difference between no growth company, which is simply this? What's the difference between no growth company and the company? Growth firms, right? Which is I won't write it. Growth firms, difference between the growth firm. Okay, I will use that subscript for growth firm, and the value of the no growth. Okay, and if you take the difference, right, So this is the difference between the two is called present value of growth opportunity. It makes sense. The only difference between the two companies, growth firm and zero growth firm, no growth firm. Come on. Right, present value of growth opportunity. So that's what it is, right? Now, we're moving on to a variable growth model. Variable growth model is also multi-stage growth model because variable means there are growth rates go through growth rate varies over different stages, right, across different stages. First thing is two-stage, and usually it is 2 to 3 stages. Why? If you understand the product life cycle, right, and I don't want to go over product life cycle, but generally the pattern of growth is something like this, right? So in other words, there's a fast accelerating growth phase, and then steady, right, growth phase, and zero growth phase, where slope of the revenue. If you measure, growth can be a growth pattern. It's the revenue. Revenue measures, this is zero growth phase, and this is negative. And nobody wants to invest in a company that's in negative growth phase. And even in zero growth phase, you wouldn't want, right? But at least, phase one, fast, phase two, slow but steady, right? Slower but steady. I mean, this doesn't look that slower, but at least we start from two-stage model, right? And then we can extend it to a multi-stage, but it would be like fast, slow, and fast again, if ever, or usually it's two-stage, So to do that, we have to use four-step procedure. I mean, that doesn't mean there are 4 stages. It's just steps of calculating. There are 4 steps, and I'm not going to go over this example because this is also the example we used in Finance 100. We're going to go to straight to actual example in the they got, but this is before we use the actual example of multi-stage growth. Let's take a look at the comparison between positive plowback and zero plowback. Okay. So we are looking at two industries that are representative of fast growth and no growth industries, and very low growth rather, low growth rather. So the representative of those fast growth industries are like computer software, right? And then slow growth, low growth. Representative of low growth industry is electric utilities. Utilities are why are the utilities low growth? Because they are natural monopoly. Okay, if you took microeconomics from the farm structures, because you have huge, these utility firms have huge infrastructure. So and you cannot even be in this business if you don't have already infrastructure already set up geographically. For example, you cannot. It's not like if you live in New York, your utility company is Con Ed, right? Connecticut is. Why Con Ed? I mean, can you not switch to another provider? Where is another provider? I mean, who is another provider? Can there be? Sometimes there are some power retailers who are nothing but just leasing the network from the Con Ed. But think about it: entire Northeast, New England, right, is powered by Con Ed. Why? Because Con Ed has the infrastructure. The gas and electricity, they have to be physically wired. In other words, your home has to be wired to the power line, which is owned by Con Ed. Gas line that comes to your home is owned by, they have, it's not like if there is a competitor, what kind of competitor will there be? I mean, the competitor will have to also lay down this infrastructure all over New England, all over the Northeast. But then it's not like you can switch between Con Ed and the competitor easily, right? The whole thing needs to be entirely and besides to lay down this infrastructure network, they will have to dig up the ground with no guarantee that the existing customers of Con Ed will switch to them. So this is a double investment, right? Or redundant investment, and it costs huge amount of money, right? Even for switching the cable company, right? Most likely, the building you live in or the neighborhood you live in already served by one cable company. I mean, there's no competition. I mean, the only competition would be direct TV, like satellite TV. Otherwise, these are physical infrastructure. So that's why they are natural monopolies. And then the initial investment to become a natural monopoly is huge. It takes a lot of capital to lay down all this infrastructure network. That's and just like the MTA. there's only one MTA, right? There's no competition, because who's gonna dig up the ground all over again? 7th Avenue, 6th Avenue, 5th Avenue, or Second Avenue, Madison Avenue, to lay down another subway line. That's gonna be crazy, right? Underground, actually, underground, the network of MTA is already very extensive and very very expensive, and I mean wide, and crisscrosses. If there was another subway a competitor, then they will have to go down much lower than the current existing MTA network, and there's going to be again digging a tunnel below another tunnel above it. This is gonna have a structural issue, right? Because it will collapse, So anyway, the idea is that's why utilities are slow growth, because they are monopolies, and they cannot expand their realm of business, overnight. In terms of geographic market, they can't expand, easily. But it's quite obvious. Look at the return on capital. What is return on capital? You understand what return on asset is, right? And return on equity, right? But overall, all the companies have, two capital components, equity and debt, right? So return on equity is only, measuring the performance of the equity, right? The profitability of the equity, whereas return is overall. But then return on equity, what is return on capital? Now, think about it. Return on equity cannot be the measure of the overall, total assets performance. Total assets performance is measured by return on assets, but assets the difference between return on assets and return on capital is capital means only long-term capital. In other words, equity and long-term debt, not the short-term debt. So the better measure of the productivity of the capital is return on capital. But look at the computer software industry. Their median is middle value. Return on capital is 18.5%, and their median payout ratio, dividend payout ratio, is 0. Of course, average would not be 0, because there are some there are companies that are paying out like 30% even. But that means median plowback ratio is what? This means, plowback ratio is 100%. Median, right? They are paying out 0 as dividend, and they all reinvest all the retained earnings, all their earnings, right? So the growth rate, the median growth rate is what? 13.3%. Whereas electrical utilities, right? Electric utilities, their median return on capital is only 6%, but their dividend payout ratio is 60%. That means their right? That means, plowback is only 40%. That's still, it's median. They will still have to plow back. Well, they will have to constantly um, they will have to constantly maintain their existing infrastructure. I mean, if you don't maintain existing, much less, expand, but they will have to. They cannot expand because it's geographically, already confined. Another company is taking up, another geographic market, but they will have to still maintain their existing infrastructure. Otherwise, they will all, deteriorate, right? And so their median growth rate then compared to, look at that, compared to, right, computer software industry, right? This, speaks amply, to the drastic effect of, plowback ratio on growth. Okay. Okay. So, okay, that wraps up, this segment. That's all the time we have for this video. We'll I'll have to stop recording, and I'll resume in the next video. I will see you in the next video then. Thank you for watching, and take care.